Welcome to Catalyst Strategic Solutions Credit Union Blueprint for 2014. We're glad you could join us for this video presentation in which Brian Turner, Director and Chief Strategist for Catalyst Strategic Solutions, will share an outlook for the year ahead and how it will affect credit unions. This presentation will include information on how economic growth will impact member spending and loan growth, how to manage funding and cost of funds, cash, investments, and surplus funds, and interest rate concerns. I would like to introduce to you our speaker for today's presentation, Brian Turner. Brian is a respected authority within the financial management and credit union industries. He joined Catalyst Strategic Solutions in 1999 and has over 20 years of financial management experience. Prior to joining Strategic Solutions, Brian held senior finance positions with numerous financial institutions, including Empire Financial Corporations of Dallas, Texas, Central Bank of Monroe, Louisiana, and Bluebonnet Savings Bank of Dallas, Texas. He received an undergraduate degree from Oklahoma State University. A frequent speaker on various topics and issues critical to the nation's credit unions, Brian is a contributor to numerous publications such as the Credit Union Journal, Credit Union Times, and Credit Union Management, and has directed educational sessions for Catalyst Strategic Solutions, state leagues, and chapters.
Hello everybody, thanks for joining us today, and congratulations for surviving I know what was a challenging 2013. We're going to talk a little bit about 2014, what we can expect from an economic point of view, not in terms of the economy of the world, but more as it relates to us as credit union managers, maybe how it's going to affect member behavior, and maybe talk a little bit about strategy, what we can do to kind of offset some of those adversity that we're seeing. So let's jump right into the economic aspect of it and growth in particular. We had very good news during the third quarter. We had GDP grew at an annualized rate of 4.1%, which is significantly higher than any of the previous quarters that we had in recent times. But if you look at the primary component, the principal component of GDP, that coming from consumer spending, it still is a very fragile 2% growth. In fact, most of the growth that came in the third quarter, as you can see, came in business investment, which increased 17% as companies replenished their depleted inventories. So the question really is, where is growth and how is growth going to come from consumer spending? And the challenge there is to look into what the Federal Reserve believes what that forecast is going to be. In fact, they're looking at a little bit more optimistic than what they've had the last couple of years. We were at 1.7% growth this past year. They're looking maybe towards a 2.2, 2.3% forecast. And again, for that to happen, a lot of this has got to come from consumer spending, which is kind of being questioned right now because people are still feeling a little insecure about their jobs. They're glad they have a job, but they're really don't know where they're going to go from there, and if they had that kind of opportunity. So the question really writes, even though we have had some job growth, can we continue to create those jobs to the extent that our members are willing to open up their wallets? So it really stems around this employment picture as we talked about before. And last year we had some good news. We created over 2 million jobs last year, but we still have roughly 10 million people unemployed. That's dropping our unemployment rate from 9.9% down to 6.7%. But as you can see, we have roughly 37% of those unemployed are long-term unemployed. In other words, they've been continuing to look for jobs now that for more than 27 weeks. A couple of key ratios that really represent the nature of unemployment or the employment picture today is 3 to 1 and 1 to 5. 3 to 1 refers to for every job posting out there, there are 3 applicants looking to fill that job. And the 1 to 5 is that for every job that was created in 2013, 5 people were removed from the labor force rolls again. And most economists believe that that has the biggest impact on the drop in recent times of the unemployment rate. And it kind of when you look at it relative to where we've been before, that the current 6.7% unemployment rate, when you look at the previous periods where we achieved that same level, whereas we're at a 2% growth in consumer spending, those previous 2 times showed significantly greater spending at 2.8% and 3.5%. And the 2% growth rate that we just experienced is the same growth rate as to when the unemployment rate was at 8.8%. So we still have a long way to go in terms of where that relates to economic growth from the consumer side.
How has member household wealth changed? What impact will it have on loans?
The good news that we've had coming out of this recession is that we pretty much have recovered all the lost household wealth that was lost during the recession. You can see that very significantly in this particular graph. And most of that increase has come from rising home prices, where over the last year alone, average home prices nationally have increased close to 14%. And if you look at this particular chart, you can see that we're seeing most of the growth are in the areas and pockets of the country that experienced the deeper decline, if you will, during the last recession. Unfortunately, this strong growth in 2013 is probably going to start seeing a slowdown in the pace during 2014. We'll still see increases in home prices, but it won't be at the same level that we've been experiencing over this last year. This is good news on the two fronts. It increases members' household wealth, which certainly, hopefully, will help them feel comfortable enough to start spending some money again. And it also helps us as credit union managers because it increases the collateral value of the assets that are securing some of our loans. As it relates to mortgage loans and the outlook in terms of sales, you can see the nice steady increase that we've had in both new and existing homes through the end of 2010. Nice steady increase, but that recently has started to drop off, particularly over the last couple of quarters. And the expectation is that is going to continue going into 2014. Most of the growth that has come in credit union loans has come from the area of real estate loans. And most of that has been in regards to refinancing applications. Whereas at the peak in 2013, refinancing applications accounted for about 82% of the total applications being issued. That is down now to in the low 60%. And and it is expected that refinancing applications will drop below 40% of total originations in 2014. And as we talked about before, that is that growth that we've really seen in the industry in mortgage loans, particularly since 2010. We've seen a nice steady trend, if you will, in real estate originations. But this is going to point out also where we are, the dichotomy that's happening within the industry itself. If you look at in this particular chart, most of that growth is coming with credit unions that are $500 million or higher. The interesting thing about that is that whereas they control roughly 2/3 of the industry's assets, they only account for about 7% of the number of credit unions. So the growth in real estate in the industry going all the way back to 2009 is strong, but most of that is coming from those large credit unions. And that's pretty much an element that we're going to be seeing in common in some of these other industry statistics. The good news is also coming from vehicle loans, where we've seen that steady growth coming out of the recession in in vehicle loans. But we haven't quite reached that 17 million unit sales that we have experienced, before the beginning of the decade. Again, that level is even higher when you look at history going forward. And this has been a strength, particularly in 2012 and 2013. It's not only translated into non-revolving credit increases, but overall consumer credit is increased as well. As you can see in this particular chart, nice steady increases going from 2009. And after the credit union kind of stumbled a little bit in 2010 and 2011, you can see the last couple of years we've really come back very, very, very strong. But again, as we pointed out before, most of that increase is experienced in the larger credit unions. Those, not necessarily because they're in an indirect program or not, it's just that they have the capacity to reach a broader group of their segments, if you will. But even with that increase that we've seen in consumer credit, it just has not translated over into market share. Look at the drop in the consumer market share as it relates to credit unions from 2009. We peaked back in 2009, a little under 12.5%, dropped all the way down to hit a nadir there in 2011 and recovered. Those 2 strong years in 2012 and 2013, not only did it increase those assets on our balance sheet, but it didn't translate a lot into our particular market share. So the question is, what is it that we don't seem to be addressing to help boosting that market share, particularly in consumer loans? It's interesting when you look at the last survey that was conducted by CUNA and asking the question of financial clients, if you will, who is your primary institution? Credit unions, we just don't measure up as well as what the banks. In fact, out of all the income categories, as you see here, credit unions only top banks in one income category, and that was the lowest category, $35,000 or a year, who consider using the credit union as their primary institution. Now, not being a primary institution is not a bad thing. I mean, a primary institution is offering all products to all people. There is strength in being a secondary institution as long as we maximize what we are giving to our products and services. At least we're being the best at those products and services. So the question still asks, is there a part of our population out there that we should market to a little bit more heavily? And the answer I have is that probably. We all focus on the baby boomers of old that back in 1982, when they were 18 to 23 years old, totaled almost 42 million people within the population. Today, they are referred to as the millennials that are 18 to 23 years old, but they number almost 46 million in the total population. So the question is, what are we doing to target our market towards these individuals? And it doesn't necessarily mean that we have to be high tech and all that. We do have to have the systems in place. We do have to have the technology that will help retain those. But are we even reaching out to this portion of our population? Again, this is a group that is due to inherit roughly $8 trillion over the next 10 to 15 years. So my suggestion is that we focus a little bit more heavily on this particular group. And I think a lot of that has to do with the loan growth numbers that we saw in 2013. Again, this shows the extreme differential, if you will, between those large credit unions and our smaller credit unions. We're probably about a 7.5% growth rate on loans for 2013, but you can see most of that came in that big top tier. Roughly 80% of the number of credit unions actually saw loan contraction in 2013. The good news is that that's a better result than what we had in 2012. And the allocations have changed a little bit. You can see the smaller credit unions still a little bit nervous, particularly about putting real estate on the books. Some of that's self-inflicted because they don't feel like they can manage the risk. A lot of it has to do with regulators and examiners who are pushing not only smaller credit unions, but a lot of the industry about real estate loans. We'll talk a little bit about that in a minute. But you can see the loan to asset ratios are very skewed, if you will. And you can see you don't see a material difference, if you will, in the delinquency rates. Although the smaller credit unions are going to be more affected by individual delinquency and charge-offs than the larger credit unions might be. And that's translating also into about a 35-40 basis point differential, if you will, into the average net asset yields across the board. So the question about loans is whether or not this 2.2 to 2.4% growth expectation coming from the Fed, is it going to come from the members and to the consumers in particular? We have to recognize that there continues to be a lot of disparity. We talk as an industry how wonderful it is that we are seeing these big growth numbers, but it's not being experienced by a large group of our industry itself. So we have to understand that disparity. We have to be sympathetic about that, and we have to recognize what we need to do to help serve our individual fields of membership. The consumer market has continued going to experience what I coined a few years ago, and that is as a market frenzy. And that is when there is so much pent-up demand right now, but it is the fact that it's being tempered by the fact that they're not willing to go out and spend a lot of money because they don't feel strong enough about their jobs. So what happens is that you have these market frenzies. We've had a couple of them in the last couple of years in particular where people say, this is it, I need to go out and spend some money. And we mostly have seen it in car loans. We had strong growth in the summer of 2013 And as fast as it came, it went away, only to return in the first quarter of 2013. Remember, as I talked about, the expectation is that real estate mortgage originations are expected to decline by as much as 30% this year. So for most of the industry, for us to even experience loan growth in 2014, a lot of that volume must come from an increase in consumer loans. And that's going to be very difficult considering what we just talked about, how fickle and how concerned the consumer continues to be over the market. So instead of coming up with some percentage expectations as to what to expect for loan growth this year, I think it's best to look back at what our performances were last year and say we probably will see a repeat performance in 2014.
Brian will now speak to growth and funding. How should credit unions manage funding and costs of funds?
Well, funding obviously is an important topic, particularly this year, and how it translates over into managing our liquidity profile. And we all know how the examiners are interested in that. Well, particularly we're seeing a continued growth in non-term shares, and really that's a good thing for us right now. Look at that strong growth that we've seen over the last 5 years in particular. I think that's going to continue in 2014. And I wouldn't be overly concerned about the drop in term certificates that we've seen over the last 4 years. That's a fundamental of what happens in this particular time in the interest rate environment, particularly. And it also goes to our suggestion, that is that it's still better for us to keep a short-term funding duration during this period of time, even if we knew interest rates were to go up, start going up tomorrow. We'll talk a little bit more about that here in just a few minutes. And that growth pattern almost mirrors what we just saw in loan growth in particular. See about a 4% annualized growth over this past year. Again, most of that came in that 7% of our community, almost a 7% growth in shares. And our remaining 80%, if you will, actually saw contraction in share growth last year in particular. We'll see how that's impacted liquidity. Maybe not as an industry, but particularly the challenges that our friends down in the smaller sizes have been experiencing over this next year. And the differentials also are in the allocations as well. You can see that our smaller credit unions are carrying a slightly higher ratio to non-term share ratio to total shares. That's twofold. One is because there's not as much of an attraction, not as much as demand for term certificates as there are with the larger credit unions. And also it helps us to manage a lower cost of funds. You can see the differential between the larger credit unions and the smaller. And we have to have that, the smaller credit unions have to have that because obviously, as we saw before, their average asset yields are down below. So in order to be able to manage our net interest margins, there has to be some accommodation in terms of the funding. Now, at this point in time, choosing a short-term funding duration by carrying a higher level of non-term shares on their books is not a detrimental thing, and it won't be going through the rest of this year. So on shares, I continue to see a positive growth going into this year, and that's because there continues to be a corollary to the increase in household disposable income. As disposable income increases, so does our share growth, and the expectation is that disposable income is going to continue to increase in 2014. I think some of the aspects, not only as it relates to our shares, but also our liquidity, depends on what happens in the equity market. 2014 should outpace 2013 in terms of growth, but we all have to see what's happening with the equity markets. You can see that we keep hitting historical highs with the Dow Jones averages. Some believe that the equity market is overvalued right now and that they're anticipating some type of a correction. If that happens, then we'll see more funds flowing in than usual. If it continues to grow at that pace of being transferred, particularly over our high-tier money market rates or money accounts, probably will start to slow a little bit, but we'll continue to deviate over to the equity market. So we'll have to watch that pretty close. Again, the allocation should stay relatively intact than what we just saw a while ago, even though there may be slightly higher term rates, because when we start talking about interest rate outlook, there may be enough incentive for people to go out 1, 2, maybe even 3 years on their CDs. We'll talk a bit about that in just a minute. Again, we pretty much are approaching those floors in our cost of funds. There is some room room for us to drop our non-term share rates, some room for our term certificates as well. But we're in that balance, if you will, between, from a liquidity standpoint, retaining as much of our shares as we can. The good news is that this is not an interest-sensitive market right now. People are not moving funds because of rates are too low or rates are too high, because they're low everywhere. And so that gives us some level of stability to expect. But again, for 2014, I see no problem with us continuing to retain a short-term funding duration.
And now, a discussion on cash and investments. What is happening with surplus funds?
Well, you know the old adage that cash is king, and that certainly is the case today, but really more importantly for a credit union is the aspect of cash flow, and particularly the concept of net operating cash flow, and that is the mismatch between loan growth and share growth. And you can see going back to 2010, share growth has exceeded loan growth for obvious reasons, to the tune of creating anywhere between 30 to 40, almost $50 billion worth of net operating cash flow. And that's put a lot of challenges in credit unions, because what are we going to do with this cash? Are we going to redeploy them into investments? Are we going to lever the institution, lever our capital a little bit by maybe shrinking? There's a lot of aspects of it, but it's the strength by which our balance sheets rule, if you will. In 2013, we actually saw a turn, seeing net operating cash flow decline as loan growth exceeded share growth to the extent that we saw our liquidity balances go down. But one thing that is encouraging is the fact the pattern of this net operating cash flow continues. You can see here in this chart that there's roughly, you look at it on a quarterly basis, that we generally bring in most of our operating cash flow during the first quarter as tax rebates come back into the foyers, as bonuses are paid, as incentive dollars are received, and then we spend those dollars or we loan those dollars out over the subsequent 3 quarters. And you can see that pattern kind of changed during the recession, if you will. It coincides, particularly in the second quarter. But you can see that our pattern from a quarterly standpoint, and again, this is as an institution, so when you look at your individual credit unions, this pattern may change just a little bit. But you can see that the strength and the expectation in terms of our net operating cash flows is very consistent to what it was going all the way in this chart to 2006. And of course, we have seen that represented in our investment portfolios. Look at the growth numbers, or the declines, if you will, last year, and that hasn't all translated over into investments. So that it has taken our investment asset ratios down to 28% of our total assets, which is only a slight decline than what we've had in the previous couple of years. But look what it is going across our peer group numbers, if you will. Again, not a lot of change, not a big shift in terms of cash and short-term investments relative to our smaller credit unions, unless you get down to that $50 million and below category, where you can see there's a sizable jump in terms of their allocation of cash and investments that are 1 year or less in duration. The investment allocation is what's really interesting here, and it probably translates into 2 things: differential in their investment portfolio yield, and secondly, the contribution that it's having in terms of their overall net asset yield. Where the smaller credit unions are seeing roughly 76% of their investments in certificates of deposit, relative to the larger credit unions that are feeling more comfortable to dealing with the more complex investments of mortgage-backed securities, agency callable debentures, and the like. And that's having a little bit of an impact on the total aspect of their investment portfolio return.
This section is about interest rates. Should credit unions be concerned about the volatility of interest rates?
Well, what's going to happen with interest rates is anybody's guess, but one thing I want us to concentrate is not just whether or not interest rates are going up or interest rates are going down. I really want us to start focusing on the spread of interest rates. You can see in this particular chart, and this is showing the Treasury curve going back the last few years. You can see that part of the Treasury curve that really impacts us and our net interest margin is way down in the short end of the curve, if you will. You can see where credit union where we earn our money relative to where we pay our cost of funds. And it's that part of the curve that really is more important to us in terms of what our earnings outlook is going to be. But again, I want to focus on us kind of changing our logic a little bit from not being so worried about whether or not rates are going up or rates are going down, but the spread. And the best way of showing that is that if our asset yield's at 10% and our cost of funds are 8%, we've got a 2% return. If interest rates decline, whether or not it's a recession or a collapse in the economy, and now our asset yields are 3% and our cost of funds are only 1%, our return is still 2%. So what we want to concentrate again is the spread dynamics of what interest rates are. So let's pull in those curves again. Let's look at the shorter part of the curve and let's talk a little bit about slope. And that's where, again, what we have to focus on in terms of our earning strength and where we can maximize the return on our assets. And you can see going back to 2010, those spreads have diminished quite a bit as it relates to the entire shape of the curve, that is the 3-month to the 2-year. We actually got a more of a flat environment going back in 2012, and we've recovered some of that. Not so much from the rise in short-term interest rates. You can see the short end of this particular yield curve between the 3-month and the 3-year has improved by about 13 basis points since 2012. But again, we're still roughly 13, 14 basis points below where we were at the end of 2010. The slope of the curve actually, although it's improved since 2011, again, we haven't seen that much improvement from so far this year, at least, but it's still about 30 basis points higher than what we were at the end of 2012. So let's focus on that slope and what that means in terms of interest rates. And that's had an impact on credit union interest rates as well. You can see on our consumer loans, particularly vehicle loans, we're down about 37 basis points from 2012 to 2013. And yet real estate loans were up significantly, 65 basis points on a 15-year mortgage, over 100 basis points on a 30-year mortgage. But you look at the nominal rate or the benchmark rates that are tied to those, you can see that there's slightly bigger movement. In fact, there was an increase in the nominal rates associated to vehicle loans, even though vehicle loans rates declined. So the difference between those two is what the spread is that we're offering, the pricing spread on our offering rates. And you can see that even though rates were up 100 basis points on real estate, we actually dropped our asset spreads by about a quarter on real estate loans by the end of the year. That differential and that spread difference is even greater when you look at our vehicle loans. Not only are we looking at lower vehicle loan rates today than what we were at the beginning of 2013, but you can see the spread, pricing spread, is dropped between 1/2 to 3/4 of a point. So what can we make up on it, if any, on the cost of funds? Well, the answer is not much because, as we talked about before, we pretty much are approaching those floors on our cost of funds. Not a lot of movement with our non-term share rates. Of course, Fed funds are about where they were at the beginning of the year. So there are not a lot of material changes in spread, even though we were able to recover about 2 to 4 basis points on the non-term share rates. The 1-year CD rate, even though we had a 29 basis point drop in average rates, the 1-year Treasury was only down about 3 basis points. So we garnered about a 25 basis point benefit on 1-year CDs. But even at 41 basis points relative to our non-term share alternatives of 10 to 19 basis points, again, that doesn't contribute a lot to our cost of funds. And this brings out a concept that I want you to think about known as relative value. And again, if we don't do one thing, we're going to do something else. If we don't make those kinds of loans, we're either going to invest it in an investment or we're just going to carry it in cash. So there's always an alternative to what we do with the funds that come into the balance sheet. And sometimes because we don't look at the spread association that we're just talking about, we kind of we lose the concept of what value continues to be out there in the marketplace. Look at this chart here where you go back all the way to 2005 and you can see our whole loan rates, those being represented by our average real estate loans and our average car loans. And even though it's declined going into this year, look at it relative to what our alternatives are and our non-core activities, whether or not it's a 2-year mortgage security or a 1-year agency debenture or even overnight funds. Whereas in 2005 to 2006, remember we had short-term rates increase so that they came close. We had a real flattening of the yield curve. So there wasn't a lot of differential between longer-term interest rates and short-term interest rates. Subsequently, we had a collapse in short-term rates relative to the recession that we experienced. And look how those spreads have widened since then. And that spread relationship continues this day, even as average mortgage rates have been on a nice steady increase over the last year. So even though rates are relatively lower than what they were in 2007, the effect on marginal income is actually greater today than what it was relative to our alternatives. So what impact does that have on, say, on an investment? Let's just take a comparison of a 3-year agency callable today versus a 15-year fixed rate mortgage. Let's look at it in context of what it does to current earnings and what it does to total return. And we're going to look at it in terms of a 5-year holding period, if you will. Well, obviously the yield differential between a 3-year agency and today's 15-year mortgage shows an adverse impact on our earnings over the next 4 years of about $81,000. So what the question would be, well, what would we have to earn 3 years from now for at least 2 more years, maybe 3 years after that, to break even against that 15-year mortgage if we chose to do the 3-year security instead? And the answer is here. We would have to have a reinvestment rate of 7.82%. When we talk about interest rates here, when we look at interest rate projections going forward, you can see that that's maybe not a possibility going forward. So that gives us that the value to the adverse impact to our current earnings actually is a greater impact than the potential impact to future earnings if rates were to go up even from here. Let's look at another comparison. Now we're going to do a 3-year agency mortgage-backed security and compare it to a 30-year mortgage. And again, the same concept here. What would be the impact to earnings? Well, the yield differential over the next 2 years, even though it's an amortizing asset, is about a loss of about $86,000. And the required rate of return 3 years from now would have to be close to almost 9%, 8.75% here, just to break even against that 30-year mortgage. So what I want us to start thinking about is that I know we're all concerned about rising rates going forward. We should be. But what we also need to be concerned is that fear that we have, is it greater or less than what the adverse impact to our current earnings is if we choose not to do something? So what can we expect about interest rates? I know that's what's on everybody's mind here lately. Well, one question is whether or not how committed the Fed is to hit these targets that they're placing out there. As everybody knows, you've hit two targets right now. They have an unemployment rate of 6.5%. As long as inflation isn't more than 2.5%, that's when they said that they might consider start raising the overnight rate target. It seems to me that they're poised to look for this summer to do that, but I don't think that they're going to be able to do that, quite frankly, because I think this summer the consumer is still going to be on the sideline. And if they're on the sideline, if they're still not willing to spend money, the last thing the Federal Reserve wants to do is to start raising short-term interest rates. That'll plunge us back into another recession. Of course, nobody wants that. So I think we're most likely looking at late 2015 still before we actually see a material increase in short-term rates. Now, I say material, that doesn't mean an accelerated pace. I'm just saying a little bit more steady increase in short-term rates. The real question, the second question would be, what pressure are we going to have on loan and investment spreads? Again, that's that 74, or the pricing spread that we talked about. We lost 75 to 50 basis points on the loan side. How much is that going to continue? What can we expect? Well, that's going to be a function of demand out there. So again, the greater exposure that we have from market spreads, the more impact obviously we're going to have in terms of our market rates. Again, we talked about before, market liquidity continues to have the biggest impact on our cost of funds. In a rising rate environment, as long as our liquidity profiles are strong, even if we start seeing increased demand on loan side, I think our liquidity is strong enough so that we won't create a competition for funds out there. And without that competition of funds, then we'll have less upward pressure on our cost of funds. So we'll start seeing our marginal asset yields going up, but our cost of funds staying relatively stable, at least on the first part of a rising rate environment. I do continue to expect to see a continued mismatch in that loan and share growth, so that will have an impact on that liquidity aspect that we talked about before. So going the expectation, probably not a lot of movement in short-term rates over the next year, but we'll continue to see this volatility in long-term rates that we've seen in the last couple of years in particular. Before, it was the Federal Reserve and their QE3 program buying and their bond buying program. They're backing off of that by about $10 billion a month. That should create a little less volatility in long-term rates, but we will continue to see rates up one day and rates down another. And so the goal is for us to be able to hopefully see our demand for loans and our demand for shares timed appropriately with those movements as we talked about. Again, the question on tighter asset spreads are probably going to occur because of the falling expectation on mortgage originations. So we'll see more vehicle loan or more consumer loan originations than we'll see mortgage originations, because those spreads are a little bit tighter than what we in their shorter durations. So that probably is still going to impact our asset yields in 2014. But as I said before, the stagnant share rates from our strong liquidity profile, and that's what's expected in 2014, should continue to allow us to have a very stable cost of funds through 2014. Just going to throw in the old proverbial forecast. Don't pay too much attention as to the actual levels here as much as the relationship again. So it's not as much this chart as maybe it is this one, looking at relative spreads. So again, there's an expectation right now that because of the volatility, the nature of long-term interest rates, we actually could see a slight flattening of the yield curve by maybe not as much by the end of this year, but certainly as we go into 2015.
To help credit unions plan for the future, this section asks the question, what should credit unions expect in 2014, and what should they do?
Well, that's a really good question. Look at what we've been talking about before in terms of the discrepancies within our network between the large credit unions and the small credit unions. Again, our larger credit unions, $500 million or greater, account for about 6% of the total number of credit unions in the industry, and yet their balance sheet shows about two-thirds of the assets of the industry. The capital seems to be shifted down to the smaller ones, which is a good thing right now because they're having the biggest challenges in the smaller credit unions. But you can still see both in each one of our peer categories, and also as an industry, we continue to be very, very strong in respect to what our net worth is to support those. The earnings obviously are being impacted because those changes in demands, as we talked about before this, and those are translating also into our returns on equity. So as an industry, as a network as a whole, we can continue to be very, very strong. But challenges, even with these improvements that we saw over last year and what we can expect in 2014 as well, you can see the challenges still remain for a good number of our credit unions going forward. So what can we expect in 2014? Again, we talked about from an interest rate perspective, little movement in short-term rates, but we can expect a continued volatility in those long-term rates, I think, going through all of 2015. Again, this rate environment specifically tied to the employment profile of the economy, and correspondingly whether or not it translates into an increase in consumer spending behavior. We see the GDP going up and going down, but it's not a steady, stable increase, which we can only get from this consumer spending behavior. Member sentiment is controlling that spending behavior because it still centers around a feeling of job insecurity, and that probably most likely will not change in 2014. So what are our specific challenges? I think quite honestly we need to ask ourselves and look towards developing two separate plans, one for existing membership and a second one for that prospective membership that we were talking about before. Ask ourselves in the development of our products and services whether or not they are things that our members are interested in, or whether or not there are products and services that are market driven. In other words, we have a tendency of looking down the street and looking at the success of someone down the street with their members on a particular product and say, well, we need to do the same thing since they were so successful, and then we're surprised when we fall flat on our performance of those. And 9 times out of 10, it's because we're introducing products and services that our particular members are specifically interested in. Again, we need to reach as the point of our membership where demand is the greatest. We want to offer everything to everybody, but we really have to concentrate on the part of our membership where we know that the demand is the greatest. And of course, let's don't forget our outreach to those millennials, as we talked about before. What I want us to focus on again is not as much about marginal yield, whether or not rates are going up or rates are going down, but I want us to think marginal spread rather than marginal yield. This will give us greater value, or give us opportunity to recognize greater value, even in today's loan and funding environment that I think what most of us perceive in this environment. And to that, we must ask the question, as I posed here, is the value lost from current earnings, is it greater than or less than the value expected from future events? In other words, are we so concerned about rising rates that we are afraid to go too far in our durations on the asset side, and because of that decision, we are not maximizing the earnings perspective today? And that enables us to evaluate what those total returns, as we talked about before, and what the adequacy is, and whether or not we actually, how exposed we truly are to rising rates. Don't forget to consider the amount that's lost to current earnings as part of that total return profile. And I think what you'll find out is that we have a greater amount of capacity to absorb a rising rate environment than what we are currently believe. Loan and share growth for next year, as we talked about before, will most likely be slightly better for some. Don't be surprised if it's slightly worse for others. And again, when it comes to our loan growth, it really is going to come down to what we can expect on consumer loans. We are expecting the decline in mortgage originations. And so in order for us to get that loan growth for this year, a lot of it's going to have to be from increased volumes in our consumer loans. Continue to create that short-term, retain that short-term funding duration. Don't be afraid of non-term shares in this environment, even at these low rates. It's going to be proof to us to be the best way to manage our long-term cost of funds. Again, not a lot of benefit from a financial point of view of attracting a lot of long-term share rates in here, just because we don't have the early withdrawal penalty that will satisfactorily lock in those cost of funds, and therefore we're just paying up too high rate of return for too high of a rate for a short-term share, if you will. If there is one thing that we really have to focus on this year is to make sure that we protect our liquidity profiles. It drives our balance sheet not only this year, but every year. It's not just the reason why the examiners are really focused on liquidity with their new regulations that are coming out and their new guidelines and policy edicts that they've asked us to do, but it always will be our lifeblood, if you will, of an institution. It will also, the stronger our liquidity profile that's balanced with our earnings profile is also going to be the make or break for a lot of us in terms of how successful we will be in 2015 and 2016. But we also have to see, because of that, we need to manage that appropriately. But in some regards, we'll find that there isn't as high a sense of urgency to deploy that surplus cash. If you have a manageable interest rate risk profile, if you have a strong liquidity profile, a strong capital profile, and your earnings are above peer, you probably have less of a sense of urgency to continue to redeploy all that cash. But it's very dependent on each financial credit union's profile in itself. My point being there is that cash continues to be king. It's very important to go forward. A lot of us aren't having the earnings profile or the capital profile we desire, so we have to keep that deployment of cash involved. For other part of our community, that sense of urgency isn't as great. In terms of relative value, for every dollar in loan principal that we are currently receiving, we have to invest at least $2.45 or loan out $1.35 in principal just to replicate the income streams that we currently are realizing. In terms of investments, though, that can change a little bit depending on what durations you invest in. But the one counsel there is that the longer the investment duration that you pursue for whatever reasons, the greater I think you need to consider using amortizing structures for that. That will help position us a little bit better when interest rates do start having a nice steady increase. Well, that concludes our discussion for today. I welcome your comments and your questions. We'll provide you with an address and a telephone number for you to send those to. And I wish you well in 2014.
Thank you, Brian. This concludes today's presentation. We hope you found the information useful as your credit union strategically plans for the year ahead.